Get Rich Education is brought to you by Norada Real Estate, Corporate Direct, and Mid-South Home Buyers.
Garrett Sutton here, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate and paper asset holdings with the right mix of LLCs and corporations. My firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention Get Rich Education for a free bonus. Switch your resident agent service to us and receive another bonus. It's all good. We look forward to assisting you at corporatedirect.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
You're listening to Get Rich Education. You're banging out GRE 88. Welcome in. I'm your host, Keith Weinhold. I'm so glad you're here. From the tip of Argentinian Tierra del Fuego through the heart of Brooklyn, New York, and out to idyllic Victoria Island, Canada, this is Get Rich Education. Busy people like you are building your wealth here. We're not just helping you survive, but thrive, because we're keeping your daydream alive. Today, we're talking about how to predict real estate prices with a great guest. What a fascinating topic. And today we're talking about that type of big picture thinking and wealth strategy that should help bring you financial freedom earlier in life rather than later. First, I want to tell you, it was June 25th, 2 years ago, that I sold my last significant stock position. I've talked about that on the show before. Sooner or later, people that are interested in financial and lifestyle betterment learn that wealth is not created by being an everyday stock, bond, or mutual fund investor. And most people never learn that, and they spend their productive lives as a job worker or even as a wage earner because they don't accumulate enough wealth to enjoy the fruits of their labor until their best years are basically over, and they look back and they realize that they traded away so much of the best chapters of their life just for dollars. But you're here, so you actually do know that. Now, I might hold stocks from time to time only for the short term between real estate deals and only in a small capacity, okay? But I sold every significant stock position 2 years ago, haven't owned stock since, and that's when the S&P 500 was at 1960, okay? 1,960 points. Well, the S&P is higher than that now, all right? And let's just say it's about 8% higher, okay? Well, a scarcity-minded or just financially uneducated person might think that, well, an investor might regret that then, right? I could have held my stock and been up 8% over the last 2 years instead of selling 2 years ago like I did, which would be a gain of about 4% per year that I could have realized, right? I mean, maybe someone's thinking that I'm feeling the opportunity cost of that one or something, or feeling some regret. No way. Of course I'm glad that I sold, okay? A 4% annual gain, that's only about keeping up with inflation, maybe, not the government reported inflation, but the real rate of inflation, okay? So on an inflation-adjusted basis, that is zero gain over 2 years that we're talking about right there. That's what that would have resulted in had I held. Plus, if those funds are outside of a tax-advantaged account, I would have also paid capital gains tax on such a 4% annualized gain. So after inflation and tax, I would have a net loss of prosperity, okay? A net loss of my purchasing power. So I'm grateful that I dumped the very last of my stocks at that time. Stocks don't create wealth. They might, and this is only a might, create a security net for you that you don't even get to realize until you're in your 60s or your 70s or even later or even never. Instead, what I did with those funds and what you can do is invest in the most historically proven investment class, buy and hold real estate, turnkey real estate, and have total rates of return that far outpace inflation. And you also have leverage, and that leverage return compounds on itself. Now, you've got 5 long-term profit centers at once with real estate this way, okay? Number 1, you have appreciation that is leveraged. Number 2, you have the monthly cash flow, which is the income that you feel every month. Number 3 is you add in your return from the tenant paying your principal paydown for you, which is often a 5% ROI alone here in just this third way that you're paid, okay? So you've already got inflation. So inflation is often covered on only this 1 out of 5 profit centers. The fourth way are tremendous tax advantages that trump employer-sponsored retirement plans. And number 5 is the inflation hedging benefit that most people kind of forget about as debased dollars erode away the weight of the mortgage debt. So those are the 5 ways. And by the way, all this is not a guarantee. There are no guarantees in really any investing, okay? This is just something that generally happens over time when you have a sound strategy and you act, okay? Real estate investing it's really kind of, I'm going to call it a game of attrition, okay? A game of attrition. With a sound strategy and action, if you hang in there, I mean, gee, it can almost be difficult to avoid wealth. It's far better than that 4% annual gain from the S&P over these last 2 years. You've got to recognize that for all that 4% annual gain is. That is a nominal gain, which is a gain in name only. It's a phantom gain, okay? Holding on to that would not have increased my prosperity at all. And many agree right now that stocks are fully valued or overvalued on a price to earnings basis today as well. So, well, back to real estate investing, I mentioned that the first of 5 ways that one financially benefits from cash flowing real estate with a loan on it is with appreciation. We probably spend more time here at Get Rich Education talking about cash flow than appreciation, but today let's talk appreciation, and we're going to do it with one of our favorites here at GRE, David Campbell. Today's guest is the mastermind behind hassle-free cash flow investing. He started investing in real estate part-time while he was still working full-time as a high school band director with zero net worth. Within 6 years and before the age of 30, our guest had become a financially independent millionaire through the vehicle of part-time real estate investing. He left public school teaching in 2005 just to focus on real estate, and his company's investing and advisory experiences included single-family homes, apartments, retail, office, medical, condo conversions, syndications, land development, private lending, even wineries. Our guest has been featured on some of America's top radio shows and investing podcasts. His blog at hasslefreecashflowinvesting.com has been repeatedly named one of the top 100 real estate blogs in America. He's widely recognized as a cash flow real estate investing expert with real estate transactional experience totaling in the hundreds of millions of dollars. He's a frequent keynote speaker at real estate investing clubs and investment seminars in California and Texas. Welcome back to Get Rich Education for your record 4th appearance, Hassle-Free Cash Flow Investing's David Campbell.
Keith, that is such an awesome introduction. I can't wait to meet myself. I'm so excited to hear what I have to say today. It's going to be exciting.
Yeah, that's right. Yeah, it's really great to have you back as always. I think Tom Wheelwright was the first 3X guest here on the show, and you've since surpassed him, and you're the first 4X guest, so you've taken the heavyweight title belt back. So congratulations.
Well, thank you so much, Keith. And you add so much value to everybody that you do business with. And the callers that listen to your show and call me afterwards are really some of the smartest people that I've done business with and met. So I sure appreciate all that you do to educate your listeners and to bring amazing content for us all to get rich.
Well, that's some great feedback, and I do have smart listeners. So now, David, as we listen to that bio a little bit, I think someone that listened closely might be able to tell that you're kind of more of a generalist in real estate, where a lot of people get rich in a niche, but you're more general.
I think that's very important to be a generalist because when you look at the market is always changing and the opportunity for profit is changing. And when you look at any type of profit opportunity, the marketplace will fill a void. And so if there is too little or too much of a particular resource, or particular need, then people are going to gravitate towards that and the profit's going to erode from that particular opportunity. And the other thing is, each of us are working with a different set of resources and skills that are continually changing. And so when I look at my a particular business plan, I'm looking at not only what opportunities are in the market, but what I want those opportunities to bring to me in my personal investing cycle, how those opportunities interact with risk, how those opportunities produce either a present benefit or a future benefit, or a tax shelter or not a tax shelter, depending on what kind of resources I need to get working at any given time.
Yeah, what really gives you this broader context and a greater perspective for understanding a lot of things with moving parts, which is what real estate is. And, one of those is real estate prices. And it's kind of interesting to talk about prices. Get Rich Education is it's kind of been a cash flow centric show. We go ahead and buy real estate for the production of passive income predominantly. And then kind of as the old saying goes, well, appreciation is just ice on the cake. But you know what, David, when I go ahead and I'll say when I look at the forensics of a property that I purchased, held for say 5 years and then sold, one thing I've done is I've gone ahead and analyzed these forensics and added up where the financial benefit came from that I received in conjunction with ownership of that property. And even though I bought that property for the production of cash flow, I often learn that the appreciation, the leverage appreciation, is actually where I felt more net benefit from during that hold period than I did from the cash flow.
I think that's a very common story. And when we're looking at the benefits of real estate, the movement of price, not necessarily the movement of value, and we can talk about that later in the show, the difference between price and value. That movement of price is the thing that is the big carrot that people are working for. And it's the cash flow that gives the investor staying power. Because if you can hold a property through time, and that time being market cycle, one or more market cycles, then you're going to make a lot of money in that price, in the increase in price of that asset, either because the property has gone up in value, meaning its utility has increased, or because the demand for that particular property has increased, or the supply of that particular property has become more restricted, or something that is a little bit more difficult to conceptualize is the currency in which that property is denominated. Perhaps that currency has increased its supply or its demand or its velocity. And those variables kind of just create different permutations of pricing that manifest at different times in the market cycle. And that's kind of a complicated set of variables to work with. And the cash flow is oftentimes a much simpler thing to explain, right? The income is X and the expenses are Y, and the leftover money is the cash flow, and that's Z. And hopefully that cash flow is positive, that the money moving into your checking account is greater. And the more cash flow you have, that's good for your profitability, but more importantly, it gives you sustaining power, it gives you holding power. If you've got a positive cash flow property, you can hold it indefinitely. If you have a negative cash flow property, then there's only so many negative cash flow properties that you can own.
Yeah, that's right. And that's something that I personally began to learn around 2008. In some of the properties that I held, I actually became a little bit underwater on those properties. They were worth less than what I bought them for, even a little bit less than the loan amount. But the cash flow is what sustained us. And I have since experienced appreciation in those properties. So with appreciation, a lot of times we're talking about price versus value when we go ahead and look at what we call what that asset is worth and what we say in our everyday terminology. Tell us about price versus value.
So value is the usefulness of an item, how you can use that particular item to bring present benefit to you. For example, if a home has two bedrooms, well, it has a two-bedroom utility. If it has three bedrooms, then the utility of that property has gone up, the value has gone up. Sometimes an increase in value also results in a corresponding increase in price, but that isn't always true. Sometimes you have an increase in price without a change in value. Sometimes you look at the row of houses and nothing happened but time, and suddenly prices are going up. And that has nothing to do with that home bringing you more utility or more value, more present benefit. It's just the currency in which that home was denominated changed. There was something in that currency that changed that caused the price to go up.
It's kind of interesting to look at the interplay between price and value. In fact, as I think about it, I think one could make the case that over time, if the value is defined as the usefulness of an item, then over time, the price of an item, as in a piece of real estate, say a 3-bed, 1-bath home, the price might go up over time, while the value goes down, perhaps, in a 3-bed, 1-bath home, because people don't live in small 3-bed, 1-bath homes anymore as much as they used to. So although the price denominated in dollars of that asset has gone up, maybe the value, the utility, and the usefulness of that over time can go down because it's deemed as obsolete if it's not renovated.
I think you're right on to something, particularly when we look at the improvements on a piece of real estate, like the sticks and the bricks. The utility of those usually goes down because they depreciate, they wear out. The thing that is going up in value or utility oftentimes is the land. Meaning, let's say you have a piece of dirt with a house on it, and as the world grows up around that piece of dirt and developments become more dense and the job centers are closer and perhaps the cost of commuting becomes more expensive, then the location, the piece of dirt, is becoming more value. The dirt has more utility because of its proximity to other desirable pieces of dirt and the amenities that on those dirt. But the actual improvements are constantly depreciating or going down in value. And so what we're seeing is this movement in value of dirt, movement in value of the improvements, and then confounding that is how the currency plays into that. For example, my mom is a retired woman and she grew up and she tells a story that she used to be able to take a quarter. Her mom would give her a quarter and she would take the bus to the movie and buy a movie and a popcorn and a piece of penny candy and take the bus home for a quarter. And the utility of those things hasn't really changed. A bus is still a bus and a movie is still a movie and a piece of candy is still a piece of candy. But the price of that moved from 25 cents to probably $25 or more for that same experience. And what changed is the currency itself, that money doesn't buy as much as it used to buy, partly because the supply of currency is greater and the availability of credit in today's economy means that money is moving faster, and that increase in velocity makes the price of things go up.
Yeah, that's a good example. The usefulness of that experience hasn't changed very much. However, the price went up in multiples. So you touched on something really interesting with talking about the dirt here, as we're talking about a component as to how to predict real estate prices today. Dirt, more or less, it's something that doesn't need any improvement because it doesn't debase effectively. Yeah, I think the dirt's a component a lot of real estate investors don't think about, and that dirt is often, maybe 1/4 to 1/3 of the price of a total property.
So that dirt, it's saying in real estate, it's location, location, location. So, we're going to throw out the usefulness of, say, minerals or using that dirt for farming or something. But just looking at that dirt is a piece of value because someone's going to either live there or have a business on that piece of dirt. That location within a marketplace or that location of the real estate and in terms of its traffic count in front of that particular street or the schools that are around that piece of dirt, those are all bringing value to the dirt so that you could say, this piece of dirt is going to be more valuable than that piece of dirt. But that doesn't necessarily result in price. And so that's kind of our theme is how to predict real estate prices, because you can experience a time where value stays constant and price goes up, or value stays constant and prices go down. And that's one reason why you look at my bio and you see so many different types of investing, because over multiple market cycles, I started investing in the early 2000s where real estate went up in price. It didn't necessarily go up in value, but it certainly went up in price in the early 2000s. And then at the end of the 2000 decade, prices went down. And it doesn't mean that the utility went down, just the prices went down, partly because the wealth effect. People felt like they had less money. The availability of financing changed. And so people had a harder time getting commodity of dollars to purchase that real estate. So when we're looking at real estate, we have supply of the real estate, demand for the real estate, and capacity to pay. Those three have to go together: supply, demand, and capacity to pay. And then when we look at the currency side of things, I kind of envision it like a front wheel of a bicycle and a back wheel of a bicycle. And they're kind of intertwined together. And the back wheel of a bicycle might be supply, demand, and capacity of pay for the actual physical property. And then the front wheel or the front gear of a bicycle might be the supply of currency, the demand for currency, and the velocity of currency. How quickly is a dollar moving between two parties? Those six variables kind of work together to, I think, be one of the greatest predictors of future real estate prices.
Yeah, supply demand with capacity to pay. I think that very much ties into how to predict real estate prices. I guess what really should an investor look for when they're trying to predict the movement of real estate prices? I think there's certain things on the demand side, like if in migration exceeds out migration, that trends positively toward demand. If there's a lack of supply of developable land due to maybe some geographic boundaries, that might constrain supply. What are some other things that investors can look for as it just refers to basic economics 101, supply demand in predicting real estate prices?
That's an excellent, very concrete thing that we can study and quantify. As a home builder, I own home building companies in two states. I'm looking and predicting real estate prices is very important to me because I want to understand if I purchase my raw ingredient of land and I put improvements on the land, can I sell that home for a greater price than the sum of those two inputs? And obviously, when I take dirt and I put improvements on it, the value has gone up, but it doesn't necessarily mean that the price is going to be greater than A plus B. And so when I'm looking at future prices, the thing that is quick to market in home building is the taking something from an improved piece of dirt to a house. That's about a 3 to 4 month process in a production home building cycle. The thing that takes a very long time is the improvement and entitlement of dirt. So you could go look out at an area and see miles and miles and miles of open space, but that doesn't mean that that open space is going to get quick to market and produce buildable housing anytime soon. Possibly because that open space is dedicated open space, it's dedicated farmland. The zoning is such that in our lifetime will never be urban sprawl housing because of governmental restrictions. The other thing is looking at the replacement cost for housing. In the economic recession that we just came through, in many parts of the country, the cost of dirt plus the improvements on the dirt plus the vertical construction on the dirt was less. It was less than what you could sell that property for. And so that means that things were trading below replacement cost. When real estate is trading below replacement cost, you can be pretty sure that the supply is not going to increase. When things are trading above replacement cost, significantly above replacement cost, you can be pretty sure that the supply of that product is going to increase. As entrepreneurs move to fill that void in the marketplace, the supply is going to increase. And so, as a home builder, when I was buying land in the recession, I was buying improved lots, meaning it was a piece of dirt with roads and curbs and gutters and utilities, electric and sewer and water, all to the site. And I would look at that lot and I would say, it would cost $30,000 to $50,000 to take that piece of dirt from raw dirt into improved dirt. before I could even build a house on it. I have to improve that dirt. If I could go buy that lot for, say, $15,000, not only was the dirt free, but the improvements I was buying at half price. Somebody was losing out on that particular investment. They improved dirt and lost money because they couldn't take it to the next step, which is building a home and selling it because things were below replacement cost. So when I'm looking at supply, for example, housing in a particular area, the availability of dirt is interesting, but more important to me in the short term is the availability of improved lots, and then the availability of those improved lots to be purchased at a price point that would allow a builder to make money. And when that magic point in the market happens and builders can buy lots or create lots at a profit, you're going to see a lot of increase in supply. But the fastest injection is really when there's an oversupply of lots already. That's when you want to just say, the supply of product can increase very quickly because there's a lot of unbuilt lots in a particular submarket. The availability of land, there could be a lot of land, but unless it's improved land, the time to market is going to be years rather than months.
We're investors, time is money, and it often takes significantly more time to develop a site than it does to improve that property and go ahead and build the structure once that site's ready for construction.
Yeah, that's correct. And the time of money is important, and also the risk factor, because I am looking at certain markets where I'm building in, and I'm very happy building in those markets, and my crystal ball looks really great 6 months out. But if I look at, I could buy this land, spend a year in entitlement, and then a year in terms of building the improvements for this land, and then maybe it takes me 3 years to build out the houses on this particular site. That's 5 years from now. And I look at my economic crystal ball and it simply doesn't go that far. There's too many variables between now and 5 years from now at this point in the economic cycle for me to take on that risk. And so I'm very much preparing my businesses and preparing my personal portfolio for what would happen if there is an economic recession. Because when it's clearly a buyer's market, well, you want to buy. When it's clearly a seller's market, you want to sell. And when you're somewhere in between, which is kind of where we are now, I think we're in a seller's market with a couple buying opportunities still hanging out there in the marketplace. Particularly in this market, the buying opportunity is debt. If you could go get cheap debt and you overpay for your property, but you underpay for your interest rate, long term, you're going to be doing great, because we talked about early in the show, it's about cash flow. If you could buy a property expensive, spend a lot of money for a property, but it cash flows and you hold on to it for a couple market cycles, you're going to be really happy. I tell a good story. My parents bought a home in Southern California in 1970, and they paid about $50,000 for that house. And at the time, they probably overpaid, quote unquote, overpaid for that house, in 1970. And then you fast forward, 40 years, and they sold that house for $500,000. Don't they wish they had overpaid for every house in the neighborhood? Right? It would have been pretty smart to overpaid for every single house because of the time, right? And probably the thing that would prevent most people from overpaying for all the real estate that they can get their hands on partly is down payment capital and partly is the cash flow, right? So there's another great soundbite that you're going to overpay for every property that you buy, because if someone were willing to pay more than you, they would be the owner, not you.
Right. That's an interesting concept. That's a great way to get a person to buy nothing ever.
Yeah.
Well, one other thought related to this, David, for my listeners, if they want to be sure that they're going ahead and investing in a property where they feel like supply and demand are pretty much commensurate with each other for their risk appetite, is there a resource online or elsewhere where a listener can go learn, well, hey, is there going to be a whole lot of supply coming onto the market that's going to go ahead and dilute the desirability of my product so that I can anticipate that?
So there are companies that produce lists of lots. They keep track of how many lots are available in a particular marketplace, et cetera. Those lists generally are not available to the general public. They're not usually online. Title companies that specialize in working with home building companies oftentimes produce that type of data, and then they offer that data to their home building clients. Sometimes it's just a value add service to earn their business. And there's companies that are in the business of aggregating that data and selling it. I would say for the average single family home investor, it's probably going to be too much white noise to look at data like that. When I'm looking at very consumer friendly metrics on predicting prices, I think the easiest one for me is look at where the jobs are going. Where are the jobs being created? Because where there's jobs, the jobs are going to create net positive migration. And the concept of look where the puck is going. Don't look where the puck is, look where that puck is moving to. And if you look at where that puck is moving to, that's the trend. And if you can invest with the trend will be your friend. And so when I'm looking at job creation, I want to also look at who your biggest partner is in every single financial transaction, and that's going to be the government, the state, local, and federal government. They're going to be your partner in everything because they're manipulating supply, in some aspects, manipulating the demand for currency by having a hand in interest rates, et cetera. And they're able to manipulate markets through taxation policies. And so if I can partner with a government that is going to be favorable to job creation, then I have a good feeling that that's going to bring positive migration or positive population growth. And then that's going to be good for me as an owner of property that I want to rent to my customer, which is people that need to live there and have a job. So some of those government policies, for example, the state of Texas is very aggressive about recruiting large employers to come to set up shop in Texas. Texas gives them huge state income tax break. There's no income tax for residents of Texas. The business income tax is very favorable, and the cost of living is low. Land is relatively affordable. And then you look at just overall like cost of insurance in Texas, because if you lose a lawsuit in Texas, it's a loser pay state. And so there's a lot less frivolous lawsuits in the state of Texas. So there's all kinds of moving parts at the governmental level that would cause businesses to move in or move out of a particular area. And if you find those drivers that you think are going to stimulate business growth, then very likely you're going to have population growth to go with that.
Well, real estate investing is just so interesting. There are so many complex things for consideration. And I think the important thing to know is one individual investor doesn't need to know everything. So David and I have been talking quite a bit about the land and construction as that relates to predicting real estate prices. When we come back, we're going to talk more about the finance side. You're listening to Get Rich Education. Our guest is David Campbell. I'm your host, Keith Weinhold. More when we come back. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
This is the Real Wealth Network's Kathy Fettke. And you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education with our guest, hassle-free cash flow investing's David Campbell. So, David, we're talking about demographics, and demographers will tell you that, demand is very tied to in-migration and out-migration, having a birth rate that exceeds the death rate, and some other things. But one maybe lesser-known factor that real estate investors are interested in looking at is something called, I'll just call it the U-Haul factor, where you can actually go ahead and look at a moving company's migration patterns.
Yeah, U-Haul publishes an annual report as well as a couple national moving companies where they can see where people are moving to. You can also just anecdotally price a plane ticket from point A to point B and then backwards from point B to point A. And it's the same flight, it's the same amount of gas, but the demand for those flight patterns, and same with moving truck rental prices, probably even more so with moving truck prices, because if you move a truck from A to B, it's oftentimes stuck in point B and it's not returning. So you can kind of anecdotally see where there is greater demand, and where there is greater demand, the prices will be higher. And so, for example, when I looked at that U-Haul report, I noticed the move from Los Angeles to Texas was more expensive than the move from Texas to Los Angeles, because everybody's moving to Texas and they have an oversupply of trucks that they want to send out, because everybody's moving here, but we need to get our trucks back to the places where people are originating from. And so they incentivize those return moves with lower prices.
Yeah, absolutely. Now, one component that deals with capacity to pay and increasing demand for property has to do with financing. And sometimes to a beginning investor, that might confuse them a little bit in the interplay between financing and the demand and the capacity to pay for property, and what's really going to affect the higher price of a property. And the thing I like to tell beginning investors is, okay, let's just say we remove all financing. There's no such thing as financing for real estate anymore. You need to pay cash for every property that you contemplate purchasing. Well, what's that going to do to price? Okay, we know that that's going to make the price go down significantly, because if someone has $100,000 and they're interested in real estate investing, they can only buy one $100,000 home. But with financing, they could buy 5 homes with a $20,000 down payment on each one of those. So it's the availability and the lubrication of financing that really helps with capacity to pay and demand, and therefore price for real estate.
So when I look at capacity to pay, it starts with jobs and debt to income ratio, and the ratio between median income and median home price. And so when I'm looking at a family who's making $50,000 a year and they're buying a $100,000 house, well, that's an excellent ratio. They're using 2 years of salary to buy a home. When I look at a market that is a very high cost market, maybe the median income is $100,000. That's significantly higher. And the median home price is $1 million. Well, that's 10 years of salary to buy a home, and that's significantly unaffordable just in terms of a ratio between income and home price. When I look at the injection of financing into that equation, now we're looking at debt to income ratio. And so let's say a family is using 20% of their gross income to buy a home. Well, that's very affordable. That's a very financeable debt to income ratio. When I look at someone who's making a median income and they're trying to buy that median home price and they're using 60 or 70% of their median income to buy that median home, that's not affordable. Not only could they not do it from a budgetary standpoint, but conventional lenders through years of experience have known that if people are using more than about 45% of their gross income towards housing, then their loans are going to be at greater risk of default. And so lenders oftentimes restrict that debt to income ratio to a maximum of approximately 45, in rare exceptions up to 50% debt to income ratio. And so interest rates play into that debt to income ratio, because as interest rates go down, the monthly payment goes down, which means someone with the same income can afford to purchase a larger home because the payment is the same, right? For the same payment, they can buy more. As interest rates go up, then the payments go up for that same price of property, which means they can afford less, right? Because their income probably stayed the same when the interest rate moved. And when their income stayed the same, their capacity to pay is going to increase or decrease depending upon interest rates. So as rates go up, their capacity to pay goes down. As rates go down, their capacity to pay goes up. The other thing is looking at how loose or liberal the lending guidelines are. And so in the real estate boom in the mid 2000s, from about 2003 to maybe about 2008, that boom was largely created not by interest rates, but by liberal lending standards. And they had stated income loans. Basically, if you could fog a mirror, you could get a mortgage in 2005. And that put a lot of people into housing that might not have ordinarily afforded it. And the same with negative amortization loans, which is a funny thing. I bet 50 years from now, if we've learned from history, people will say, negative amortization loan, what's that? That seems like a crazy idea. But that negative amortization loan, what it did is it allowed people's debt to income ratio to go down, makes their payment go down, and that allowed people to finance more, which gave them capacity to pay more for the property.
And for those that don't know, a negative amortization loan, that is like an interest-only loan to the extreme, okay? It's not an amortizing loan where you need to pay principal plus interest. It's not an interest-only loan where you only pay interest. Negative amortization loan is a type of loan where you don't even make a complete interest payment every month, and that really loosened things up and enabled more people to qualify. Now, David and I are talking about how loose and easygoing the lending environment was in the early and mid-2000s. After the mortgage meltdown 2008, 2009, the adoption of Dodd-Frank in 2010, things got quite tight. And David, I see signs, anecdotally and otherwise, that things are starting to get more loose and the pendulum is swinging back. Therefore, that puts more available buyers in the buyer pool that may not have qualified previously. For example, a few weeks ago, I had a mortgage loan officer on the show, and just a couple little things, we're starting to see more cracks. The first one is that the reserve requirement for conventional loans just a few years ago was such that you could only use 60% of your retirement balance toward your reserves, and now you can use 100%. And also, one previously could put 20% down on their first 4 single-family home income properties, and now it's 20% extended all the way to your first 6. So that goes ahead and creates more buying opportunities, puts more people in the buyer pool, and might indeed increase price pressures.
Absolutely. So when I'm looking at predicting real estate prices, trying to understand where the puck is going, if you are in a tight financing environment with high interest rates, the only way for the market to go is looser, which would create greater capacity to pay, which means prices can go up. If you're investing or you're acquiring assets at a time where interest rates are incredibly low and lending guidelines are very, very loose, then the thing that could change, for example, what can't go up must go down, what can't go down must go up, right? So if rates go up and lending restricts, then that capacity to pay is going to go down, which will bring prices down with it. So I wish there were a very simple formula, but it's kind of like predicting the weather. There's just so many variables, and you look at your 10-day forecast and you say, well, it's going to be sunny. And then tomorrow you look at your 10-day forecast and say, well, it's going to be rainy. And the only thing that changed was the length of the outlook. For example, I can look at the weather forecast in the morning and say this afternoon it's going to be rainy, and it's probably going to be right because you're looking at a very short-term time frame from the prediction until the realization of that prediction. And the farther you look out, the murkier it gets. And it's just because there's so many variables, and we're not working in natural law, because natural law would be very simple, which would be supply, demand, and capacity to pay. And there it is. You could predict those variables. But when we insert the variables of currency and the government manipulation of currency and the government manipulation of interest rates, we don't have free markets to be able to make predictions, because depending on who wins an election, a year from now or 5 years from now or 9 years from now, all of those things are going to influence economic policy, which will influence prices. Generally, when I look at currency, I want to know, are we going to have inflation or deflation? And if there's inflation, then you want to own physical real estate that's leveraged. If we have deflation, then you either want to own physical real estate that's unleveraged, no financing, or even better, you want to be a lender. Because when you were looking at market cycles, and if prices are going up, you want to own the equity. If prices are going down, it's better to be the lender, not the equity holder. Because a $100,000 property with a $75,000 loan on it, if that property declines from $100,000 to $75,000, that equity investor just experienced a 100% loss.
It's a total wipeout.
Total wipeout. That lender in that property, when it went from $100,000 to $75,000, they've got a $75,000 loan against a $75,000 property. Just for oversimplistic education perspective, that lender didn't lose money. There's obviously some transaction expenses if they have to foreclose on that asset, but from an actual book value perspective, they didn't lose money on that loan, because if the borrower still pays that $75,000 loan back, the lender didn't lose money, whereas that equity investor might have lost 100% of their investment.
Right. So if you're trying to anticipate predicting real estate prices and you see that as going down, being a lender is a way to hedge yourself. And David's a master at helping people learn how to be a mortgage note lenders. And David's going to tell us more about how you can get a hold of him and do that prior to the show ending. I think there's such gold and such a great takeaway in there before we started to talk a little bit about mortgage note investing and being the lender. And that is, you and I, we started investing in the early 2000s in real estate. So we've seen a couple cycles of this. And I think the takeaway that is such gold for a listener when it comes to having lax financing standards by the government is in 2006, when things were so loose and you could put a zero down and get a loan, and you could just go ahead and state your income and not back it up and reinforce it with anything, and maybe someone wasn't even reading your application, that's really a sign that that's introduced so much more capacity to pay and demand into the market that, the only place you can really go is down. So as soon as we get back into an environment like that again, and we're not nearly there yet, that's just another sign that if you're trying to predict real estate prices, that puts significant downward pressure on it if it's super loose.
That's correct. And so when I look at risk and reward as an investor, when everybody's selling, that's the time to buy. And when things are the hardest to get financing, that's the time to buy. When it's really, really loose and it's easy to buy and interest rates are low, that's an excellent time for cash flow investors to get in. And it's an excellent time to acquire very long-term assets. Because as we were talking earlier, if you overpay for the property, but you underpay for the financing, in 3 to 5 years, you might say, oops, right? The market declined, and now I find myself at the bottom of the market, and the bottom of the market is less than where I purchased, and you might have yourself underwater equity. But if you are the beneficiary of an incredibly low interest rate loan and you're still cash flow positive, value only matters when you sell or when you refinance. Let me say that again, because we distinguish between value and price. Price only matters when you sell or refinance. And if you're not selling or refinancing, the thing that matters is cash flow. And if prices go down in some states where they're evaluating the property taxes based on market value, it's possible that your price goes down, but your cash flow goes up. It goes up because your expensive property taxes are going to go down. And potentially when prices are going down, there's more distress in the marketplace. And that puts people out of home ownership and into the renter pool. And that puts greater demand pressures on the rental market, which potentially makes rents go up and occupancy rates go up as well.
Yeah, that's a great point. So, David, this has really been an insightful discussion. It really tells us a lot about the relationships and how one can predict real estate prices. What's the best way for our listeners to find out more about you?
Well, Keith, I have a great article on my website that I'd like to share with you and your listeners that's called How to Predict Real Estate Prices. And it's a great extension of today's conversation. Also, if someone is interested in having a free investor consultation, they can actually schedule a half-hour phone call with me for free by visiting my website, hassle-free cashflowinvesting.com. So at hasslefreecashflowinvesting.com, there's an orange button that says click the schedule, and they can set up a time to talk with me about their personal investing goals and what they're hoping for their own financial independence. I also have a great newsletter that I offer for free. So somebody can go to my website and sign up for my newsletter and just stay in touch with my insights on the market and various investment opportunities as they come available to my readers.
David Campbell is both the best and the most available, I'm going to say, real estate investing strategist that I know of. Since he's such a generalist, you can get so much from a consultation with David. He can help you see things that you didn't even know about yourself in your own portfolio. So I really suggest you look into those resources. David Campbell, thanks so much for coming back on to Get Rich Education.
It's a pleasure to be here, and congratulations on such a successful show.
Yeah, it's always great to have David Campbell here. Price is what you pay, value is what you get. Let me know how I can help create wealth for you here on the show. You can always leave your comments at getricheducation.com. You can do that with either your voice or with email there. Check out Get Rich Education on social media too. Next week, we're going to connect you with a turnkey real estate provider that we're featuring here on the show, and they represent the largest city in what has long been called the most landlord-friendly state in America, and I made a real estate field trip there myself. Until that show next week, have a great week, think abundantly first, and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.